Well, for more on the markets, let's bring in Rob Williams, Managing Partner and Chief Investment Strategist at Sage Advisory. Rob, thanks so much for joining us today.
Thank you for having me.
So what do you make of the latest data out of the U.S.? Those retail sales seem to be, underscoring the resilience that continues for the U.S. consumer.
Yeah, not what bond investors wanted, but, we're in a very rate-driven market. We know that. We're in this good news is bad news for rates and equities, meaning anything good for the economy, especially the consumer, is going to impact rates to the upside. And it didn't surprise me that equities struggled a little bit. That's just kind of the world we are in right now as we get towards the end of the cycle here on the rate side. I think the bad news is that, this volatility in rates is going to continue. I think they're going to continue to overreact to any positive data. And the issuance needs are pretty high. And we're missing, one of our biggest buyers, the Fed, the most price insensitive buyer of treasuries, is sort of stepping away. Mm-hmm. But I think the good news is, to your point you said earlier, is that we don't think there's going to be hikes in November either. We do think they're going to kick the can down the road. There's data to justify going either way, but the Fed has had a number of speakers out the last several days, and the message has been a little more dovish, and it's been towards the point that we don't need to hike in the immediate term. We're going to wait and see.
You like bonds right now, though, don't you, Rob?
I do. I think just because we're going into the higher for longer sort of trend doesn't have to mean higher. I think the longer part of it's there, but over the medium term, I like bonds. I think, growth is fading globally. Risk, when I look around the world, I think risks have gotten higher, not lower. Geopolitics, strikes, just higher for longer itself raises the economic risk over the medium terms, lending conditions, liquidity conditions. So I like the outlook for bonds going forward. Maybe the near term, you're going to have to put up with a lot of rate volatility, but over the medium term for bonds, I think we're very close, if not at the end of the cycle. You're getting a lot more yield. You're getting, in a month, what you used to get in a whole year, about a year and a half ago in core bond yield. So I think it's time to revisit, adding duration or lengthening your bond allocation, or just having more bonds versus equities. That's not a bad time, given the yield move we've just seen.
Yeah, what sort of volatility do you think investors should expect on the equities front?
Yeah, equities, it's funny, it's kind of the opposite of the bond market, where near-term rate volatility, I like it medium term. Equities near term, if rates do go down, equities is going to like that initially. But I think the medium term is where you have to worry about the volatility coming into equities. I think rate volatility has been too high. Probably equity volatility has been too low. But I think the medium-term headwinds are going to change that. That we see the consumer fading over the next couple of quarters. Our base call is still a soft recession, not a terrible recession, but a soft recession sometime into the end of the year, early next year. So I think it makes sense to be defensive on equities right now.
Are there particular areas that you think, have more potential on the equity side of things right now?
Yeah, I mean, probably the areas that have been beaten up because, this correction, because it's been rate driven, has beaten up some parts of the market that you usually go to be defensive. Staples, high dividend sectors, some of the typically low REITs, some of the higher yielding, lower vol sectors have been beaten up. But I think that is part of the late cycle playbook. So I think you want to stick with some of those parts of the market and not stick with some of the areas that are overvalued. You don't have to take a massive tech underweight, but I would be moving, if possible, some money from that area to some of the lower vol defensive sectors still.